My name is Cody Stegeman. I am a value add investor in the Midwest. And over the last 5 years, I have bought over 50 units using a value add system that we've developed. And today I wanted to take a few minutes and go over a duplex that we underwrote earlier and kind of go over the specifics to evaluate whether or not it is a good deal. So even though underwriting is arguably the most important part of real estate investing, we found that most people actually suck at it. So that's why I wanted to take this time to go through these specifics line item by line item on how we underwrite these deals to make sure that we don't lose money. So to dive into the specifics for the deal itself, this is actually an off-market pocket listing from one of our local agents that we know really well. The seller is incredibly motivated. They want $200,000 for it, but I think we could get it cheaper. And we know that the current rents of $1,800 are actually low for the market based off of other properties we have here in town. So now we went over some of the general details of the property. I wanted to dive into the specific numbers line item by line item and kind of go through where our thought process is in terms of underwriting this deal, what the specific numbers mean, and whether or not this is actually a good deal. So as we said before, the current asking price is $200,000. But this is a pocket listing, so it has not hit a listing service yet, and the seller is incredibly motivated. So we know there's a really good chance that we'll actually be able to get this deal for less than that $200,000 price. The next line item is rent. Currently, it's at $1,800, and based off of our other units we have in this market, we actually know that number is close to $2,000. And this just reinforces why it's so important to understand what the rent metrics of your local market is, because when you evaluate these deals, if you know there's potential for an increase in rent, that just means there's opportunity on the tail end to increase value and increase cash flow depending on the purchase price. So the next line item, owner paid utilities. This is an easily overlooked line item that a lot of people forget about when they're doing their budgeting. A lot of times properties, especially in small multifamily, you have to pay for water, sewer, or if the electricity isn't submetered, you have to pay for the electricity, et cetera, et cetera. So always make sure you understand what the owner paid utilities are and how that affects rent pricing and obviously your bottom line if you have to make an allocation for that. Next is taxes. Taxes on this place are $3,200 a year or $266 a month. Now, of course, property taxes do tend to go up year over year, but usually it's a small amount and it can be adjusted for inflation. So we usually don't worry about projected increases unless there's something drastic coming. Up next is insurance. This property is $2,400 a month. We got that number based off of other properties we have similar size, similar condition in the same area. This is always an important thing to underwrite. Reach out to an insurance agent, give them the property address, and actually get a quote for the insurance. Just because a lot of times, especially in today's markets, insurance prices are increasing wildly and unexpectedly. So make sure you take the time to do proper underwriting for what your insurance costs are actually going to be. Up next is our payment. It's $1,090 a month, and that payment is based off of that $200,000 purchase price with 20% down on a 25-year note. So as far as standard commercial options, if you're not buying a primary resident, you're buying something as a rental, you're usually going to have to put down either 20% or 25%, and your amortization rate is usually going to be 20 years or 25 years, not 30. So whenever you're trying to figure out what your payment is going to be, always make sure you've had conversations with a lender, understand the products that they offer, and underwrite accordingly, because this price can vary a ton depending on if you're doing a 20-year note, a 25-year note, if you're putting 20% down, 25% down. So always make sure you have those conversations with your lender so you know exactly what that payment is going to be before you dive into the underwriting process. So that means all of our total cost inputs, our PITI, which stands for principal, interest, taxes, and insurance, is $1,556 a month. And I know initially you want to say, well, our rent is $1,800. Our PITI is a little over $1,550. That means we have about $250 a month in cash flow. But this is where people being bad at underwriting is a trap and can cost you a lot of money, because owning and operating a rental costs a lot more than just this fixed payment every month. And we're saying this from a place of confidence. We have owned a ton of units over the last decade, and we keep track of what these cost inputs are, and there needs to be additional allocations made or you will lose money owning and operating this property. And the primary allocation on top of the PITI that we need to account for is an expense ratio. So I actually do have another video that dives into what an expense ratio is really deep, but at a surface level, it is a dollar allocation for these core items every single month: management, vacancy, maintenance, capital expenses, and a small miscellaneous budget for random things that come up. And what this expense ratio is listed at right now is 35%. And I know 35% feels like a lot of money every single month, but I can promise you, we keep track of the numbers we have over the last decade over all the units that we have. And this number holds true. And it isn't just us. Most bank underwriters, when they're looking at a deal, will use anywhere from a 30 to 45% expense ratio, depending on the property. So if we're operating around that 35% of gross rents for an expense ratio, that's $630. So if our gross rents are $1,800, our pity is a little over $1,550, and our expense ratio is 630, that means as this deal sits right now, buying it at full price with the current rents, we would cash flow negative $386 every single month. So as it sits, it's obviously not a deal. We're not going to buy a place to lose almost $400 every single month. So beyond just cash flow, there are other inputs that come into play when underwriting and evaluating these deals. And some of these are going to be driven by an individual's specific buy box and investing goals. But for us specifically, looking at this deal, if we could get it at $160,000, we would be open to that for a couple primary reasons. One, we already operate in the market. Two, we know that rents are progressively going up in this market. So I think even in the short term, these rents are going to be a lot closer to like a 2,200 or 2,400 opposed to staying at that $2,000 mark. Plus, we know that with an increase in rents, this property will be worth over $200,000, more like a 220 or a 230. So if we could get this deal at a 160, we more than likely would buy it because it would lead to not only a little bit of cash flow every single month, but we would be looking at anywhere from a $40,000 to $50,000 net worth increase for our portfolio. And I know that the idea of asking or making an offer at a price that far below what she wants can be uncomfortable. But the reality is, a lot of people, unfortunately, if they're in circumstances where they want to move quickly and they don't want to have to deal with the burden of having people come through their unit, set up showing times, deal with agents, et cetera, you can get these lower prices on these properties and make it a win-win for both parties. And this is why it is so important to underwrite these deals fully and completely so you have an idea of what price point you need to be at. And then you can unapologetically go back to the seller and tell them, hey, this is the price I need to be able to make this deal work. So either write down or screenshot this formula and you can apply it towards any small multifamily underwriting you have. And just remember to make these allocations really intentionally. Do your due diligence, talk to a lender, talk to your insurance agent, figure out what property taxes are. Make sure you're double checking all this information. Just don't take what you've been given at face value. Run the numbers really specifically, figure out what price the deal has to be at to make it work, and make an offer. And you're going to get a lot of no's, unfortunately. It's going to be really uncomfortable, but I promise if you underwrite enough of these deals, you're only going to get better at it. You're going to get faster at it. You're going to know what these prices need to be for the deals to work for you. And the more times you ask, you are going to start getting some yeses. It just takes a lot of volume to be able to make it happen. So start underwriting deals. Start throwing out some offers at sellers and numbers that make sense and put yourself on the path to financial freedom, and your future self will thank you. So good luck underwriting, and we'll see you in the next video.